And when we're constructing portfolios, that's the key. We need to be focused on the future, not what has already happened. Hi, I'm Dan White, Client Portfolio Specialist with ARK Invest. On this season of The Switch, we're going to address how innovation performs in times of market turmoil. As always, we will be joined by ETF Trends to facilitate the discussion and make sure we don't leave anything unanswered. So let's continue the conversation by exploring why innovation should be a key component of a global equity portfolio.
Dan, I know you're talking to thousands of advisors every year and a lot of fans of ARK ETFs. They love it on the upside, but they also say, man, these ETFs are volatile. So what guidance could you give?
Yeah, we hear this a lot all the time. And we often see that the first metric many advisors are going to look at our funds, it tends to be standard deviation and tracking error against some kind of benchmark of their choice. And in isolation, ARK, using those numbers, we're always going to look higher on the risk side if you're using those metrics when we compare to the more traditional index conscious investment managers. And it kind of has this feeling that risk and standard deviation have become synonymous, which at the high level feels a bit strange because standard deviation, it's a backward looking metric on how prices have moved. There's no forward view there. And when we're constructing portfolios, that's the key. We need to be focused on the future, not what has already happened.
I mean, is part of this that we're just inherently as human beings so bad at thinking about risk? I mean, we have much more loss aversion than we have appreciation of profit. And yet we use these sort of bilateral mechanisms like volatility and standard deviation. Is it valid for investors to be using that, or should they be looking at something else to really understand their risk?
Yeah, that's spot on. I think in kind of how you explain that behavioral nature of humans and investing, and on top of that, I think there's just so much scar tissue from these last two asset bubbles that really that first, second, third thought is risk aversion, and investors want to find a way to quantify that. So many are using that historical data, but that can't predict the future. So there needs to be some type of degree of qualitative analysis to really assess the risk that's in your portfolios. You can't rely just on a number.
So the big risk is under allocation. And then when we talk about emotions, whether you're an individual investor or an advisor, it tends to be you only make that real, true allocation after the market's kind of had a run. Talk about that if you would.
Yes, the all too often buy high, sell low scenario. And that comes from that under allocation and getting excited. A real basic one you can think of would be your general cash level versus your equity. But as we've seen the proliferation of passive investing, we think many investors are actually under allocated to innovation. There are many large companies in these passive market cap weighted indexes that are primed for disruption that investors, they may not be prepared for because they're under allocated. And it's really important to be able to maintain that emotional part of investing, hold that in, and find moments where you can dollar cost average into these opportunities.
So Dan, you put together some great examples of what it looks like to actually slot some innovation into an overall portfolio in sort of a global equity and bond portfolio. Can you walk us through some of those examples? Because I think they're pretty telling.
Yeah, so we have a few sort of what if model portfolios where we presented this so every investor can kind of take a look and think through it, because we want to show how innovation can impact a portfolio. So investors then take that and they apply it to their own portfolios just to see what it could look like. So we created some basic core equity exposures for a global equity portfolio. We have 60% domestic, 30% international developed, 10% emerging markets. And then we add in innovation at 5% intervals while maintaining that 60-30-10 split in the rest of that sort of prorated portfolio.
And Dan, the trade-off between added risk and return is really profound. Whether you like the Sharpe ratio or Sortino, you're getting a significant boost in performance for increments of risk. Talk about that a little bit as you talk to advisors.
Yes, and we believe, kind of as Ren said in a previous episode, that to capture this, you really need to focus on analyzing these innovative opportunities in the research and the portfolio construction step, because you need to see the diversifying nature that innovation has against traditional value. And what surprises many people is against traditional growth. So it's our belief that by adding innovation into a total portfolio, you can enhance those your long-term risk return profile of a portfolio. We also believe that innovation is very misunderstood in the markets currently, and that's because of the legacy sort of research framework. And that by adding innovation in and its misunderstanding, you can create asymmetric return patterns. If you look at the histogram of just ARK's returns, you'll notice that innovation has a fatter right-hand tail, that upside, than it does the left-hand tail, that downside. And we think that's a culmination of just that misunderstanding in the market, that it can create this more attractive risk upward versus downward profile.
But a big part of that is that we're not measuring this sort of on a week-to-week or quarter-to-quarter basis, right? I mean, the numbers we're talking about here are over multiple years. We're not chasing the latest headline. How important is the time horizon to this?
Yes, I'm glad we kind of bring it back here to the time horizon, because that really is so important. It's important enough that we have a whole previous episode on the switch dedicated to just that, taking advantage of the time horizon arbitrage. Wall Street has become so focused quarter over quarter on these metrics that investors are losing sight of that finish line. And that volatility in the middle really creates these opportunities for a disciplined investor to be dollar cost averaging into innovation that may cause disruption in sort of these larger legacy holdings they may have in their portfolios.
Well, Dan, thanks for taking some time with us to help us understand that it's not just about performance, it's really about correlation and how things fit in your portfolio.
No, thank you, Dave, and thank you, Tom, for such a fun conversation. And we look forward to having you both on the next season of The Switch.